The markets opened Monday and the worst fears began to materialize, not in the catastrophic crash that some had predicted, but in the steady, grinding decline that signals institutional investors see prolonged pain ahead. Hong Kong's Hang Seng Index tumbled more than 2.5%. Tokyo's Topix declined nearly 2%. S&P 500 futures pointed to a decline of almost 1% for the American session. And across every asset class, the repositioning that began over the weekend accelerated as traders processed the reality that this conflict is not ending anytime soon. But then the news hit that changed everything. 3 United States service members were killed, the first American casualties of the Iran war, announced by U.S. Central Command, confirmed by the Pentagon, and responded to by President Trump within hours. In a pre-recorded Truth Social post Sunday afternoon, Trump said he would avenge the deaths of those 3 service members. He said combat operations in Iran that began Saturday would continue. This is no longer a precision strike designed to eliminate leadership and withdraw. This is now an active war with American blood and a commander-in-chief promising vengeance. The path to de-escalation just became dramatically longer. The probability of prolonged conflict just increased substantially. And the financial markets are only beginning to price in what that means. Let me show you exactly what happened Monday and exactly what it signals about the weeks ahead, because the people who understand these dynamics now will be positioned for what comes next. The people who do not will be devastated by a prolonged shock they never saw coming. Gold prices surged past $5,130 per ounce on Monday. That is more than 12% higher than a month ago. When gold moves 12% in a month, it is not normal investment rotation. It is panic buying. It is institutional investors and central banks scrambling to find safety in an asset that cannot be frozen, sanctioned, or devalued by any government's policy decisions. Analysts in Asia noted a wave of emergency buying of the dollar. Emergency buying. That phrase tells you everything about the sentiment in trading rooms from Tokyo to Hong Kong to Singapore. This is not calm repositioning. This is flight to safety in its most intense form, and that emergency dollar buying sent regional currencies, including the Japanese yen, sliding against the U.S. currency. The most acute impact is in the oil market. International crude prices briefly crossed $80 a barrel as trading resumed Sunday, before retreating from some of those gains. By Monday, prices hovered near $76 a barrel. That is still roughly 7% above levels seen a week ago. A 7% move in oil in a single week is enormous, and the conditions for further increases are present in every dimension of the conflict. Ship traffic through the Strait of Hormuz has dwindled. This is the vital shipping lane for oil leaving the Middle East. 20% of global oil flows through this narrow waterway, and the tankers that normally pass through continuously are now frozen. Tankers are starting to build by the Strait of Hormuz, but nothing seems to be going through at the moment. Tankers are definitely spooked. Those are the words of Matt Smith, oil analyst at energy consulting firm Kapler. The tankers are spooked. The captains are refusing to sail. The insurance underwriters are reassessing every vessel. And the oil that normally flows to power the global economy is backing up at the entrance to a waterway that has become a war zone. A prolonged closure of the Strait of Hormuz is a guaranteed global recession. Those are the exact words of Robert McNally, energy analyst. Not a risk of recession, not a possibility of recession. A guarantee. 13 million barrels per day move through that strait. If it closes, if tankers cannot pass, if the oil that powers Asian manufacturing and European industry and global transportation stops flowing, the economic damage is not hypothetical. It is certain. What you would see is hoarding, especially by Asian countries that were big importers of oil and gas when they realized that Hormuz is closed. McNally continued, you would see the mother of all bidding wars, the mother of all bidding wars for oil, countries competing for shrinking supply, prices spiking not because of speculation but because of physical scarcity, an energy shock that makes 2022 look modest, a 1970s-style crisis that reshapes the global economy for years. This is what markets are beginning to price on Monday, not the full recession scenario yet, not the 100+ oil that would accompany a prolonged closure, but the increasing probability that this conflict extends, that the strait remains restricted, that the guaranteed recession moves from theoretical to imminent. Now let me show you what the death of 3 American service members means for the trajectory of this conflict. Because this single development changes everything about the political dynamics driving the war. Before Sunday, the strikes could be characterized as a precision operation. Target the leadership, eliminate Khamenei, disrupt the regime, withdraw without prolonged engagement. That was the narrative that markets were hoping for. the 12-day war precedent from June 2025, suggested conflicts could be sharp and short with limited lasting damage. But American casualties changed the political calculus entirely. 3 families in America are now grieving service members killed in combat with Iran. Trump has personally committed to avenging their deaths. The domestic political pressure to continue operations to ensure those deaths were not in vain, to achieve something that can be called victory, is now immense. David Silby, a professor of military history at Cornell University, warned that Iran may lash out harder after the joint U.S.-Israel strikes killed Supreme Leader Khamenei. The Iranian regime sees its very existence at stake. They are going to do whatever they can and whatever they believe will help them stay in power. Retaliatory attacks could include missile strikes on Israeli and U.S. military bases and vessels in the Persian Gulf, as well as potential terrorist operations across the Middle East, Europe, and the United States. This is not just an oil market story. This is a global security story that touches every dimension of economic activity. Airlines canceled hundreds of flights in the Middle East. Air India said it was suspending all flights to the Middle East on Saturday, as well as flights between India and both Europe and the U.S. scheduled for Sunday. Airspace closures over a large area of the region due to security concerns have disrupted global aviation. Business travel is frozen. Tourism is canceled. The logistics of moving people and goods through one of the most important transportation hubs on Earth have been thrown into chaos, and the Islamic Revolutionary Guard Corps has promised their most intense offensive operation is coming. Not a measured response, not proportional retaliation, their most intense operation. Targeting Israeli and American bases, targeting the infrastructure that has made U.S. power projection possible in the region. Now let me show you why the stock market is particularly vulnerable to this shock. Because the composition of the market has shifted in ways that amplify exposure to exactly this kind of crisis. The market dominance of technology companies has waned this year as concerns about artificial intelligence mount. For years, tech giants drove market returns. Their profits were largely insulated from global commodity prices and geopolitical upheaval. Apple does not suffer when oil prices rise. Microsoft does not lose money when the Strait of Hormuz closes. The tech-heavy market could absorb Middle East shocks because tech earnings were disconnected from Middle East events. But that dynamic has changed. The new drivers are industrial and energy companies, which are more directly tied to the global economy and world events. Industrials need oil to manufacture. They need logistics to ship. They need stable supply chains that span continents. When those supply chains are disrupted, when oil prices spike, when shipping becomes dangerous, industrial companies suffer directly. Some analysts said this has left the market more vulnerable to the current shock from the Iran war. The same rotation that was supposed to diversify the market away from overconcentration in tech has actually increased exposure to exactly the kind of geopolitical shock we are experiencing. Energy stocks are the exception. Oil companies themselves, whose stocks have already been lifted in recent weeks as oil prices have been rising, are expected to continue to benefit from the disruption. In Tokyo, Japan Petroleum Exploration, an oil and gas producer, saw its shares climb more than 7% on Monday. To me, the most obvious thing here is if you are overweight oil stocks, then you are happy. That assessment from Michael Purvis at Tallback & Capital captures the narrow winners from this crisis. If you own Exxon, Chevron, BP, Shell, the independent producers, the exploration companies, your portfolio is rising while the broader market falls. The conflict that devastates most sectors enriches energy, but oil prices are a cost for most companies. While short-term fluctuations are unlikely to have much effect on corporate balance sheets or the U.S. economy more broadly, sustained disruption to the oil market could hurt companies that are heavily dependent on oil, like airlines. Airlines face a double hit. Higher fuel costs crush margins. Canceled flights eliminate revenue. Reduced passenger traffic even on routes that remain open signals consumer fear that further reduces demand. The economic damage compounds. Higher transportation costs mean higher prices for everything that moves by truck, ship, or plane. Higher input costs mean lower profit margins across manufacturing. Higher energy costs mean reduced consumer spending on discretionary goods as households allocate more income to gasoline and heating. Now let me show you what Barclays is telling its clients. Because when one of the largest banks in the world issues a specific warning about not buying the dip, you need to understand why. We would recommend not buying any immediate dip. The risk-reward does not seem compelling. Those are the words of Ajay Rajadhyaksha, global chairman of research at Barclays. He said the market could fall over the coming days before any rebound. This is significant because buy the dip has been the winning strategy for over a year. Investors have been rewarded repeatedly by buying when the market declined and then quickly recovered. tariff fears, tech sell-offs, Fed uncertainty. Every decline was followed by a rebound that made dip buyers look smart. But the conflict with Iran could present a period of prolonged uncertainty for markets. That is Barclays' assessment. The path to de-escalation in Iran is not as clearly laid out as it was when the United States and Israel targeted Iran's nuclear facilities in June 2025. That conflict lasted 12 days. Oil spiked 15%. Then everything normalized. This conflict has already claimed American lives and prompted a presidential commitment to vengeance. The precedent no longer applies. There is likely to come a time to buy. Rajadhyaksha continued, but not yet. When a senior research executive at a major global bank tells clients explicitly that the time to buy has not arrived, that the risk-reward is not compelling, that more downside is coming before any recovery, you are witnessing institutional capitulation on the optimistic scenario. The smart money is not buying this dip. They are waiting for lower levels. They are preparing for worse news. They are positioning for a prolonged conflict that the surface market movements have not yet fully priced. For now, investors remain broadly sanguine, anticipating a short-term shock across markets that is currently expected to last a few weeks at the most. That is the consensus. A few weeks, but the consensus has been wrong before. And the factors driving this conflict, dead American soldiers, a decapitated Iranian regime fighting for survival, oil infrastructure at risk, the Strait of Hormuz restricted, all of it points toward duration that exceeds a few weeks. I would not be surprised to see stocks close up on Monday and oil down. That counterintuitive view from Peter Cheer, head of macro strategy at Academy Securities, reflects the volatility and uncertainty that makes positioning so difficult. Markets could rally on short covering and optimism about containment. Markets could crash on escalation news. The range of outcomes is so wide that confident predictions are impossible. But the weight of institutional opinion, the Barclays warning, the emergency buying of safe haven assets, the spooked tanker captains, the canceled flights, all of it points toward caution rather than aggression. The time to buy may come. But it is not Monday, it is not this week, and it may not be for several weeks or months depending on how the conflict evolves. Now let me show you the inflation and interest rate implications, because even as the conflict threatens recession, it simultaneously threatens higher inflation in a way that traps central banks even further. While a rise in oil prices is typically inflationary, pushing up interest rates, the latest shock is likely to add to the risks for the global economy, potentially leading to increased expectations of central bank rate cuts in anticipation of any negative impact on the U.S. economy. This creates a paradox. Oil prices rising is inflationary. Inflation argues for higher rates or at least no cuts. But a prolonged oil shock damages the economy. Economic damage argues for lower rates to provide support. The Fed faces the same trap I described in my previous video. They cannot cut because inflation is rising. They cannot hold or hike because the economy is weakening. There is no good option. If Iran closes the strait, it could drive oil prices into the triple digits, while LNG prices retest the record highs of 2022. That assessment from Saul Kavanik, head of energy research at MST Marquee, describes the 1970s-style scenario that markets fear most. Triple-digit oil. Record LNG prices, energy costs consuming ever larger shares of household and business budgets, inflation spiraling beyond the Fed's ability to control, and recession arriving anyway despite the inflation because the real economy cannot function without affordable energy. The core PCE inflation rate is already expected to rise to 3.1% in January, the highest in 2 years. That was before any impact from the Iran strikes was calculated. If oil prices remain elevated, if the conflict extends, if the energy shock persists for months rather than weeks, that 3.1% becomes 3.5% or 4% or higher. The Fed's 2% target becomes a distant memory, and the rate cuts that traders were expecting become impossible regardless of what happens to the labor market or growth. Any $10 increase in crude oil prices raises consumer price inflation by 0.2 to 0.4 percentage points over the coming year. Oil has already risen roughly $10 year to date before the strikes. Another $10 to $20 increase would add 0.4 to 0.8 percentage points more. Cumulative inflation impact of 0.6 to 1.2 percentage points on top of already elevated readings. That is the math of an oil shock translating into persistent inflation. Now let me show you how members of OPEC Plus are responding, because the supply side dynamics determine whether this shock intensifies or moderates. Members of OPEC Plus, the large international group of oil-producing countries, have said they intend to increase their oil output to try to counter any hit to supply from the war. This is the stabilizing response that markets need. If Saudi Arabia, UAE, and other producers can ramp up production quickly enough, they can partially offset lost Iranian supply and restricted straight traffic. But there are limits. OPEC Plus has been managing supply carefully to support prices. They have spare capacity but not unlimited. If the Strait of Hormuz closes entirely, if tanker traffic cannot pass, increasing production inside the Gulf does not help because the oil cannot get out. The bottleneck is not production capacity, it is transportation through a waterway that is now a war zone. And there is the question of Iranian retaliation against OPEC producers. The Abqaiq processing facility in Saudi Arabia handles up to 7 million barrels per day. Iran attacked it in 2019, knocking out 5.7 million barrels of daily production. If Iran is fighting for regime survival, if they believe their existence is at stake, attacking Saudi infrastructure to raise the costs of the conflict for American allies is a logical strategic move. It spreads the pain. It makes the war costly for everyone. It creates pressure on the United States to negotiate rather than continue military operations. If Abqaiq is hit again, if Iranian missiles damage Saudi production capacity, OPEC Plus cannot increase output. They would be scrambling to maintain existing output, and the oil supply shock would become severe rather than manageable. Now let me bring all of this together, because Monday's market action is just the beginning of a repricing process that could extend for weeks or months depending on how the conflict evolves. The Hang Seng dropped 2.5%. The Topix dropped 2%. S&P 500 futures indicated a 1% decline. These are significant moves, but they are not crashes. They are not the panic selling that would indicate markets have fully priced the worst-case scenario. They are the beginning of a process that Barclays explicitly says has further to go. Gold at $5,330 and climbing tells you that sophisticated investors are seeking safety outside the financial system. The emergency buying of dollars tells you that even a weakened reserve currency is preferred to alternatives during acute crisis. The spooked tankers refusing to transit Hormuz tell you that the physical supply chain upon which the global economy depends is already disrupted. The 3 dead American soldiers tell you that this conflict has become politically impossible to exit quickly. Trump cannot withdraw without appearing to abandon vengeance for fallen troops. The Iranian regime cannot surrender without accepting the end of its existence. The dynamics point toward prolonged confrontation rather than quick resolution. And the market positioning tells you that institutional investors are not buying this dip. They are waiting for lower prices. They are preparing for worse news. They are hedging rather than speculating. The time to buy may come, but not yet. If you own stocks, expect volatility. The decline is likely to continue before any recovery. Energy stocks will outperform. Everything else faces headwinds from higher costs and reduced economic activity. Do not panic sell, but do not assume this is a buying opportunity. If you own bonds, Treasury prices are rising as yields fall on safe haven buying. But if inflation spikes from oil, long-term bonds face eventual pressure. Short-term bonds are safer than long-term in an environment where inflation trajectory is uncertain. If you hold dollars, the currency is strengthening on emergency buying. That strength may persist as long as the conflict continues. But it does not protect you from domestic inflation that erodes purchasing power regardless of exchange rates. If you hold gold, you are positioned for exactly this scenario. The surge to $5,130 may continue if the conflict extends. Gold performs during crises. This is a crisis. If you were planning major purchases, consider the uncertainty. Oil prices affect transportation costs, affect everything you buy. Higher inflation means your money buys less. The timing of major purchases should account for a potential period of elevated prices lasting weeks or months. The guaranteed global recession that McNally described is not here yet. The strait is not fully closed. Oil is at $76, not $100 plus. The worst-case scenario has not materialized. But the conditions for that scenario exist. The risk is elevated. And the market movements on Monday show that institutional investors are taking that risk seriously. I am not a financial advisor, and nothing I say should be taken as financial advice. But what I can tell you is that Monday's market reaction is the beginning, not the end, of the repricing process. 3 dead American soldiers, a president vowing vengeance, an Iranian regime fighting for survival, tankers spooked at the strait, airlines canceling flights, gold surging on emergency buying, and Barclays explicitly telling clients not to buy this dip because the risk reward is not compelling. The comfortable assumption that geopolitical upheaval does not affect markets has been tested. The assumption held through Venezuela, it held through the June bombing. But this conflict is different. Khamenei is dead. Americans are dead. Combat operations are continuing. And the path to de-escalation is not clearly laid out. Wall Street has largely shrugged off geopolitical upheaval in recent years, reflecting that conflicts have had little effect on the profits of major publicly traded companies. That historical pattern may not hold this time. The market composition has shifted toward industrials and energy that are directly exposed to global events. The conflict has escalated beyond precision strikes to active warfare with casualties. The oil market faces potential disruption that previous conflicts did not threaten. The precedent of buying every dip has made investors wealthy. But Barclays is warning that this dip is different. The risk reward does not favor buying. More downside may come before any recovery. There is likely to come a time to buy. But not yet. Subscribe to Market Acme right now and join our WhatsApp community for real-time updates because this conflict is evolving hour by hour. Trump's vow of vengeance, Iran's promised retaliation, tanker movements through the Strait, OPEC production decisions. Every development changes the calculus. And the repricing that began Monday will continue as new information arrives. I am Kenzo John. I am not a financial advisor. This is Market Acme. And I will keep showing you what the institutional investors are actually doing, what the market signals actually mean, and what the gap between surface calm and underlying repositioning reveals about where the smart money expects this to go. The markets opened Monday. The decline began. The gold surged. The dollar caught emergency buying. The tankers refused to sail. And Barclays told the world that the time to buy has not arrived. There is likely to come a time to buy, but not yet. Those words should guide every financial decision you make until the conflict resolves. Not hope, not optimism, not buying the dip reflexively because it worked before. Caution, patience, and understanding that this time may actually be different. 3 soldiers are dead. The president has promised vengeance. The Iranian regime is fighting for survival. The Strait of Hormuz is spooked, and the repricing has only begun. Join our WhatsApp community for updates because when the next development breaks, when Trump's next statement arrives, when Iranian retaliation escalates or de-escalation begins, you will need to understand what it means immediately. The time to buy may come, but not yet. And the difference between understanding that warning and ignoring it will be measured in portfolio losses, in purchasing power, in financial security that depends on not being on the wrong side of a prolonged conflict that Barclays and the smart money already see coming. Monday was the beginning. The path to the end is not clearly laid out, and everything between now and resolution will be volatile, uncertain, and dangerous for anyone positioned too aggressively in either direction. The time to buy may come, but not yet.